For the remaining two videos this week, we will cover a very top-level overview of the Great Depression and the global financial crisis of 2008. Both are empirically complicated creatures, so we will really only touch on the surface, but both are financial crises, and more specifically banking crisis at core. They're also the two largest recessions on the book in the past 100 years, and depending on how the world economy may be able to reopen next year, depending on whether we have a vaccine or not, at least in the US, by some measures, both of these will be deeper recessions than the current pandemic. Starting with the Great Depression, what we're looking at here is a crisis that began with a stock market crash in October 29 on a Tuesday, known as Black Tuesday. Stock prices had been rising rapidly throughout much of the 1920s, and the still young Federal Reserve, which had only been established in 1917, viewed prices as excessively high. In response, the Fed tightened monetary policy, and as a consequence of that, stock prices collapsed sharply. The crisis then was exacerbated by a dry harvest season. You may have heard of Dust Bowls, that's what that referred to in the time, which caused many farmers to default on their loans. Thinly capitalized banks started to mass default in the early 30s, and by 1933, amidst a generally weakened economy, about 1/3 of US banks had defaulted. One consequence was that both private and corporate credit continued to take a hit well into the decade. This too is a common phenomenon during financial crises. And as we briefly mentioned before, the US in the early 1930s then entered into a deflationary period, which made it even worse for the financial system, as real debt obligations began to rise after inflation, resulting in the largest and longest recession in the past 100 years. As a matter of fact, the Great Depression was so deep that statistical offices like the Bureau of Economic Analysis were specifically developed to bring up measures like GDP or the unemployment rate to help us understand better what the state of the economy actually was. Prior to the 1930s, there weren't many such measures available. For this reason, we don't often have perfect measures for the Depression years themselves, and statistically speaking, we don't know things 100%, but when you look at, for instance, unemployment, the estimated unemployment rate peaked around 20 to 25%, depending on who you ask. By comparison, just to put this into perspective, during the current April lockdown, the US unemployment rate touched about 15% in April of 2020. That is the largest on record since we measure unemployment, which was, of course, only since after the Great Depression. With a modest initial government response during the Great Depression, breadlines and shanty towns quickly formed all over the country, and there's quite a bit of literature on this, which I recommend reading, so you get a sense of just how dire an economic crisis that really was in comparison. Now, let's look at a few data points that we have. Following on our previous discussion, what we have here is the Dow Jones Industrial Average expressed as dollars per share throughout the 20s and 30s. This is an example of a financial asset price bubble. Economic growth during the 20s had been relatively modest. Average stock prices more than quadrupled from 1922 to 1929 this period. And again, much like with home prices in the 2000s, you see this sort of accelerating pattern followed by a sharp contraction, by a sharp drop. From Black Tuesday to 1933, practically all the gains of the 1920s had been lost, and with them lots of wealth and income for many investors. Stock prices did not recover throughout much of the 1930s, and yes, even dipped back into a mild double-dip recession in 1938. The number of banks at the time was larger than today, and many banks were small agricultural lenders. Milton Friedman and Schwartz wrote an important book about this called The Monetary History of the United States, which provides a detailed account specifically of what happened to banks during the recession. Macroeconomically speaking, the Great Depression was such a big calamity because it caused a dramatic contraction in credit to pretty much anyone. This graph in front of you indicates the volume of quote-unquote other loans provided by member banks within the Federal Reserve System at the time, which means loans to customers, consumer loans, loans to banks, open market loans on commercial papers, and real estate. So this is a pretty broad definition of what loans would be. While credit expanded at a reasonable pace during the 20s, the outstanding loan volume fell by nearly 15% into the early 30s, and it remained there really until the end of the decade. Part of the problem here was that the Federal Reserve and the Treasury did not partake in large-scale bailouts early on, the way we are used to them doing that. The Fed did not take any emergency steps to save banks and deposits early on, and President Hoover, especially in the early years of the depression, relied mostly on voluntary action and more than modern type fiscal support. We'll see more about what I mean by that in the next video. At the same time, and one of the more characteristic patterns of financial crisis, corporate credit spreads moved up sharply. So this is the difference between corporate bonds of different qualities and the underlying treasury. Similar maturities, they're not exactly matching because you can quite get them. But keep in mind from our discussion of the loanable funds model and the risk structure that what this reflects is the risk premium on corporate borrowers. Now, especially low-rated bonds, indicated by the blue line here, moved up sharply. But even the highest quality corporate borrowers saw an increase in spread of about 15 points in the early 30s. So around this time of the recession, it became very, very difficult for corporations to borrow, which in turn meant less employment, it meant less investment, and it just prolonged the extension of the crisis. Finally, and this is a little different, I had mentioned this earlier, the Great Depression saw deflation. These are consumer prices. This is not quite the CPI that you're used to. This is an index. It's an older measure from the NBR. And you can tell that prices had sort of been growing steadily, at least throughout the 20s. And then they fell very, very sharply from about 180 to about 130. So this is a contraction of about a third over 3 years. That's a pretty significant drop in prices. We don't really have another one like this. And then again, even by the end of the decade, prices hadn't quite recovered back to where we were. Now keep in mind that deflation is good for lenders and is bad for borrowers, because effectively what deflation does, it means that whatever your monetary burden on your loan is going to increase over time, right? You need to work more because money gains value over time. Now it looks a little more dramatic than we would expect this. We don't really see deflation much because this is still going back to the gold standard sort of times. Deflation was more common during this period of time than it would have been today. But there is hardly a region, hardly a time that you can find where you would have seen such a sharp contraction early on. The reason why it eventually ended was that the Fed then started to expand the money supply a little bit more in the mid-30s, which was one of the big reasons why we came out of the recession. Now, what was the policy response? There's a pretty large literature on this. The policy response merits have been widely discussed, not only in the economic, but also the historical literature. You probably have heard some of this in high school. The data is not very complete, so it's difficult to really analyze this the way we would do it today. But we have a relatively good picture of what helped us coming out of the Great Depression. Probably the most well-known response was FDR's attempt at establishing sort of a broad stimulus package under what is known as the New Deal. And the New Deal was a quintessential Keynesian deficit spending policy. It was actually a package of bills over 6 years. So it wasn't really a single stimulus measure. We take these stimulus deals to be a normal crisis response today because it's pretty much what everyone does. So it doesn't really matter if you're a Republican or if you're a Democrat. Stimulus deals are common during recessions, but at the time it was really novel. Now, in the end, the size of the new deals makes it actually unlikely that it had all that much of a macroeconomic effect. The bills were spread out over a long period of time, over 6 years, and inflation adjusted accounted for a little over $800 billion in today's term. Now, the US economy has grown obviously a little bit since, but even so, it still accounts for less than half of the size of the stimulus we just passed this spring to deal with the lockdown, which was about 2.2 trillion, about 10% of GDP. Now, all in all, the New Deal, if you look back at it, simply wasn't all that large. There are a couple of places where you do see an effect. There was a cut in funding in 1938. That's also the year the US double-dipped into recession. And the New Deal added a couple of really important social measures like Social Security, which was designed to provide for the old, which at the time had no more income, or Fannie Mae, which was designed to bring back people into housing. A couple of other things that came out of it that matter in retrospect. For one, to deal with the ongoing waves of these banking crises from 1930 to 1933, Congress established the Federal Deposit Insurance Company in 1935. We discussed this in an earlier segment. It basically ended the continuous onslaught of bank runs by protecting depositors and the financial system alike. That helped importantly. Significant banking regulation was passed. The Glass-Steagall Act is another piece we had already mentioned. And then importantly, the Fed eventually changed course on monetary tightening and started to expand the money supply more. That helped the banking sector. It probably helped the economy as well. Even so, the US really only ended a stronger recovery during the war years, which provided a pretty significant boost to both manufacturing and research and development, which was also largely funded through fiscal deficits. So that in many ways is also a Keynesian policy. If you're interested in a more detailed narrative of the Great Depression, I recommend the FDIC's write-up. A summary is provided in this link here. It's optional, but feel free to check it out if you're interested in this.